Okay, we did discuss also risk. You can measure using statistical tool standard deviation. So by looking at the distribution of the expected return and standard deviation, using the expected return or the average return and standard deviation, you can identify which stock is risky. And also you can use the coefficient of variation also to determine the stock that are risky. I think we discussed this thing, right? We discussed this thing. Then I asked you to do this one. Okay? Or we did it in the last, right? So then that's okay. Right. So now we have to start from which are the answers for this question. So I gave you expected return from here. Right. As an investor, you are investing today for future. Right. So expected return is the most important thing because you are investing today for future, expecting some future return. Previously we discussed that is average return based on the past data or historical data. So that is average. But you invest today with the expectation to have this much of dividends and this much of capital gains. So in future. So these expected returns you are expecting in future. So it depends on the economic situations would happen and company performance or some other macro micro factors would affect it. So therefore your expected return you have to identify with some probability because that is for the future. When you expect something for in future, there is uncertainty. Either it receive or not, there is uncertainty. So therefore, this uncertainty you have to cooperate with certain probabilities. Probabilities of happening a particular economy. Suppose that the prevailing economy if continue, you will get this much of return. If economy went worse, then you will get this return. So if there is a stagnation, you can expect this. So likewise, you have to identify possible returns, possible estimation, possible forecasted return with the different, with the level of its happening or the probabilities. So then, if you can identify all the happenings for the future, suppose you are investing for the 3 months, so within these 3 months, what could happen in the economy? Right? What could happen? So these are all possibilities, all happenings you have to identify with their probabilities. So under each of the economic situation, you have to forecast your return based on expected capital gains and expected dividends. In determining the expected return of a security or the stock, probabilities of occurring future returns are forecasted in accordance with the possible future economic conditions. So you can see in here, this is the point I emphasize. So, if you read the first explanation here, in determining the expected return of a stock, probabilities of occurring future returns are forecasted in line with the possible future economic conditions. So then, after you identify all the possibilities of happening, then your expected return, this is expected return, stock I, you can calculate. Expected return stock I is equal, here Ri is the forecasted return. Ri, forecasted returns of the stock under economic condition 1 under different economic condition. This is forecasted return. This is expected return. So forecasted return of the stock I under different economic conditions. If you can forecast or we can identify 3 different possible economic things, economic situations, so then you will get 3 probabilities. The total of all probabilities should be equal to 1. This is all can happen. So therefore, the total of the probabilities should be equal to 1. Then Px here, you can see Px, it is the probability of occurring that economic condition X. So if you can identify all probable things happening in the economy with their probabilities, and if you can forecast the return under each economic condition, then your expected return is equal forecasted return into the probabilities of happening in this particular economy plus next economy forecasted return under it, probability of happening it plus if you have 3 state of economics, then forecasted return under the 3rd state of economy and the probability of happening it. So that total is the expected return. That is the expected return. Right? So if I go to this section, before going to the next part, let's look at this one. You are given 2 stocks there, X and Y. State of economics, there you have identified, you are given 4 state of economics. 1, 2, 3, 4. So you can see the probability of happening in the state of economy 1.1, probability of occurring in the state of economy 2.2, state of economy probability of happening in the state of economy 3.5. So likewise, if you get the total here, this is equal to 1. This is the all happenings, but would happen in the next your investment period. So therefore, total of these probabilities should be equal to 1 incident. Under the state of each state of economy, you can see to the stock X and Y. You are given forecasted return. This is forecasted return. So this forecasted return includes 2 components. What are those 2 components? This forecasted return includes, this is investment of the equity shares, ordinary shares. This forecasted return includes 2 types of returns. What are those? Capital gains and dividend. So based on expected dividend and expected capital gains, you have forecasted here your return for each state of economy. Now calculate expected return stock X. You are given forecasted returns for each state of economy. So you want to determine expected return. I am referring here 2 concepts: forecasted return and the expected return. Forecasted return under each state of economy, based on your analysis, based on your skills, you have identified them. So then, based on this expected distribution of your forecasted return, you have to work out expected return by using the previous formula. So then, if I ask you to calculate the expected return for the stock X is equal forecasted return under the state of economy 1 minus 8.5% into probability of happening that plus forecasted return under the state of economy 2 7.2 into probability of happening it plus forecasted return under the 3rd state of economy probability of happening it plus forecasted return under the 4th state of economy probability of happening it. So that total is the expected return. So if you calculate the expected return, I am writing here because it is easy to me. So expected return stock X is equal forecasted return under the state of economy 1 is minus 8.5. Probability of happening it is 0.1 plus forecasted return under the state of economy 2, 7.2, right? 7.2. Probability of happening that is 0.2 plus forecasted return for the third state of economy 6.5. Probability of happening that is 0.5. 0.5. Probability of happening is 0.5. You can write like here, right? Then forecasted return if the fourth state of economy happened, that is 4.2 into its probability 0.2. So get the total. That's sum. You can see if you go to the previous slide, previous one. Here. This is the expected return. Expected return is equal forecasted return under the state of economy multiplied by the relevant probabilities and sigma. Sigma means summation. Sigma is the total. So then you can get the answer like this. You can do in your like this. So what is the answer? So I'm writing here expected return stock X. So let's say you can calculate expected return stock Y. Expected return ER expected return stock Y is equal forecasted return under the state of economy 1. Probability of happening is 0.1. I am writing for the stock Y. Forecasted return under the state of economy 2 minus 5.4. Its probability 0.2 plus if state of economy 3 occurred, your forecasted return is 4.3. Probability of happening that is 0.5 plus forecasted return under the state of economy 4 is 7.5 into its probability 0.2. Here plus, right? This is plus. So this total is the expected return for stock Y. Same thing you can repeat for the stock X. Calculate expected return. So you can calculate the expected return for stock X and Y. We get expected return X 4.68, expected return Y 3.42. This is the expected return. So if you know the forecasted return and distribution of this forecasted return, so based on the forecasted return and the relevant probabilities, you can calculate expected return. Okay, I think that is not difficult. Because for the exam you are given all forecasted return and the relevant probabilities are provided. So then you can calculate expected return. So next part is, now we have to calculate the risk of this expected return. Right? Earlier we discussed risk based on the average, based on the historical annual returns. So now the risk, same thing, but based on the expected return. So you learn how to determine the expected return just now. So what is the risk of this forecasted return? What is the risk of this expected thing? So that is, you can define risk of forecasted return is the possible deviation of your forecasted return from the expected return. How to define the risk of the expected thing or the forecasted return? Now you have identified four state of economy. මේ හතරම සිද්ධ වෙන්නේ නැහැ. හතරෙන් එකයි වෙන්නේ. නේ? During the next your investment period, this for all the state of economies couldn't happen. Only one can be happen. So then what is the risk? The forecasted thing, forecasted return, risk of forecasted return is the possible deviation of forecasted return from the expected return. Right? In average return, you define the risk is deviation of the particular year return from the average. When you are using the past data, historical data. So then here, what is the risk? What is the meaning of the risk? It is the possible deviation of your forecasted return from the expected number, from the expected return. So therefore, again, we are applying the statistical tool like variance, standard deviation, coefficient of variation. You have discussed it last week. So same tool, statistical properties, we are applying again to measure the risk. So you can see variance formula. I think you can notice a small difference in this formula from the previous one. When you calculate the variance standard deviation using the past data, historical data, you can turn back your slides and you can see the formula. Deviation, square of the deviation, and the total divided by n minus 1. Look at the formula. Okay. When you are using the past or the historical values, historical returns, the difference is important because for the exam you will provide the formula sheet. No need to take them by heart. Formula sheet is provided. But anyway, the correct formula you should apply. When you calculate the risk of the forecasted return or the expected return, so you have to use this formula. It is different from the previous one. Now here you can see, look at the variables. This is RI. RI means forecasted return of the stock under the state of economy X. Its deviation from the expected return stock I. How of the deviation? Multiplied by the relevant probability, or the probability of happening is economic condition X. Then next one, forecasted return under the state of economy 2, its deviation from the expected return stock X, solve the deviation multiplied by the probability of happening second state of economy, plus forecasted return under the state of economy 3, its deviation from the expected return. You have calculated expected return now. Power of the deviation multiplied by the probability of happening in the state of economy 3. You have four types of economic possibilities. So then state of economy 4, forecasted return under the state of economy 4, its deviation from the expected value, power or the square of the deviation, multiplied by the probability of happening in the fourth state of economy. So that total, so you get the total sum, that is we call variance. That is the variance. Variance. So once you get the square root of the variance, that is standard deviation. Coefficient of variation, you learn it. Risk per unit of return. The problem with the standard deviation, if you ask to identify risky stock, risky security, simply by looking at the expected return and standard deviation, you cannot take the decision. Because expected returns is different, you get the different standard deviation, so then you cannot compare. In order to make it comparable or to take the decision, you have to calculate this coefficient of variation. Did you remember coefficient of variation? We discussed last week. Coefficient of variation is risk per unit of return. Same formula. Here, coefficient of variation you can calculate standard deviation divided by expected return. In the previously, when you apply the past historical data, coefficient of variation, you calculated standard deviation divided by average, alpha, average return. Here, standard deviation divided by expected return. So that is risk per unit of return. So this three we have already discussed related to the average or the past information, past returns. So now the same thing we apply to the expected values. Right. Now we have to calculate this thing because otherwise you are not practicing this now. So if you go to the same section, same example, this one. Right. Now calculate variance, standard deviation, coefficient of variation for each x and y. Right. Calculate. Now we calculated expected return. So now you have to calculate variance, standard deviation, coefficient of variation for x and y. Right. Expected return x. Expected return x we already calculated. It was 4.68. 4.68. Expected return x 4.68%. Expected return y was 3.42. This is 3.42%. So now you can calculate variance of x. Variance of x is equal, you can apply the formula. Deviation of the forecasted return from the expected return under the each state of economy. 8.5. Its deviation from the expected return 4.68. Power of it multiplied by the relevant probability is 0.1 plus forecasted return under the state of economy 2, 7.2. Its deviation from the expected 4.68. Power of it. Probability of happening in second state of economy 0.2 plus under the third state of economy, you forecasted 6.5. 6.5. Expected is 4.68. Count the deviation into the relevant probability. Plus 4.2. Deviation from 4.68. Count the deviation relevant probability 0.2. So get the total here. This is the variance of x. So how much the variance of x? Similar way you can calculate variance for the y. We have to repeat the same thing. How much the variance is done? How much the variance? 20.94. Variance here 20.34. This is variance 20.34. Is it correct? So then once you get the square root of this, that is standard deviation. Is it the standard deviation 4.6? 4.67? 4.51. Round up here. So you get standard deviation 4.6 something, and this is the variance for the stop x. Right? So variance and standard deviation you can calculate like this by applying that formula. This is for stop x. You have to do for the stop y. So once you calculate this one for the stock y, you will get Standard deviation for the stock Y 4.51. Same thing you have to report, right? You have a calculator, you can click it. 4.67 and 4.51. This is standard deviation. Can you tell me the variance here? Variance for the stock X was 20 point. Variance was 20.34. 20.34. Various stock. This is X, right? This is X. This is Y. Variance stock Y is how much? You know the standard deviation, that is square of it is the standard deviation is the variance. It is Y. Variance Y how much? 21.85. 21.85. 21.85 is the variance. So this is standard deviation. Normally, remember this is a percentage because we are using here. Return. Return normally we input as a percentage. So therefore, your standard deviations ultimately will be in the format of a percentage, right? So the answer would be in the percentage. Right. Calculate coefficient of variation also. Coefficient of variation X. Coefficient of variation Y. So you know expected return, standard deviation for X and Y. So now coefficient of variation. Coefficient of variation of X is equal risk per unit of return. Standard deviation divided by expected return. So for the X, standard deviation is 4.67 divided by expected return. Expected return was 4.65. Okay? 68. 4.68. This is the coefficient of variation for the stock X. So then coefficient of variation for the stock Y. Standard deviation 4.51 divided by expected return 3.47. 3.47. So what are the coefficient of variation? X. Coefficient of variation Y. Point 99. X. 0.99. Coefficient of variation. Y. 1.36. 1.36. So you are with standard deviation, expected return, and the coefficient of variation for the X and Y. Now tell me which stock is risky. Expected return X 4.68, expected return Y 3.47 are different. So you cannot compare these two by taking the standard deviation because two different expected returns. So in order to make a comparison, you have to know what is the coefficient of variation. So coefficient of variation X 0.99, coefficient of variation Y 1.36. It is risky. Which one is risky? X or Y? What is the risky security? X or Y? Coefficient of variation means risk per unit of return. එක ප්‍රතිලාභ ඒකකයකට තියෙන අවදානම තමයි මේ coefficient of variation කියලා කියන්නේ. අපි ස්ටෑන්ඩර්ඩයිස් කරලා තියෙන්නේ. ඒතර කෝකේද risk එක වැඩි? ඒක return එකකට risk එක variation එක වැඩි කෝකේද? X5 1.36. But you can see there is a disagreement. If you conclude with using the standard deviation, you will say risky one is X. Standard deviation 4.67 for the X. No? So then if you compare with the standard deviation, you will end up with the answer risky one 4.67, it is X. Right? But it's wrong. Right? It's wrong. But according to the coefficient of variation, you can see the riskiest one is 5. Because it's risky, 1.36 is 1.99 X. So what is the point you should learn? To compare two stocks. Cannot do simply by looking at expected return and standard deviation. If expected return for both, it's same. If expected return for both X and Y says same, then you can compare. Then you can compare these two. But here expected returns are different, 4.68 and 3.46. So then you cannot compare. So you can standardize by calculating this coefficient of variation. So the riskiest one is Y. Lowest risk one is X. Right? Any question? Any clarification? My past country nothing is the Right. Standard deviation, variance, and the coefficient of variance. So now we go to the next one. Covariance. These are the statistical tools that you can use to measure the risk. So risk you can measure even using the covariance also. Covariance. Covariance covariance. So you can see the formula later even. So now we are going to calculate this one also to measure the risk. In the portfolio discussion, this one is very important. What is the covariance? To measure the covariance. Now variance you measure for a single or the standalone security, for a single security. But covariance you cannot measure for one security. Because covariance means co-movements of the two stocks return. Whether these two stocks returns are moving to the same direction or whether these two stocks returns are moving to the opposite direction. So likewise you are measuring co-behavior or the co-movements of two stocks returns by calculating covariance. by calculating covariance. To calculate the covariance, you should need two variables. Covariance you cannot calculate for one variable. Now here you should know two Stokes return. To calculate the covariance, you should know two Stokes return. Now if you look at this formula, even you can see we are measuring for movements of the two Stokes x and y. See here, covariance two Stokes I and j, x and y, a and b, whatever. So covariance between two Stokes returns is equal forecasted return stock I under the state of economy x. Its deviation from the expected return stock I into multiplication. Under the same state of economy, forecasted return stock y, its deviation from its expected return multiplied by probability of happening that state of economy. Right? If you have four state of economy, then go to the next. Forecasted return stock x under the state of economy 2, its deviation from the expected return stock x multiplied by forecasted return stock y under the state of economy 2, its deviation from its expected return into probability of happening second state of economy. Then plus forecasted return under the third state of economy stock x, its deviation from the expected return stock x into multiplication forecasted return stock y under the third state of economy, its deviation from its expected return into the probability of happening the third state of economy. Then fourth one. In our example, we have fourth state of economy. So then once you get the total or the summation, that is the covariance. Now, what is the importance of this covariance? Now, right. So covariance can be positive number, it can be negative one, or it can be zero. Covariance can be positive, or it can be negative, or it can be zero. Now look at this diagram. I don't know whether I can draw nicely. Say this is over time, right? Time. This is the expected return or the return. Variable is return. Right? Return. Say stock X is moving like this over the time. This is the behavior of the stock return. Return of the stock X over the time. Say Y is also moving like this over the time. This is stock Y. If you take a particular time period, say from here to here, this time gap, this some time period, both stocks returns are decreasing. Both are coming down, decreasing. If you take the point from here to here, both are increasing. Both stock returns are going up, increasing. So you can see in a particular time in the period, particular time duration, both stock returns X and Y move into the same direction. So their covariance is positive. Their covariance is positive. They are moving to same direction. Right? So once you construct the portfolio using the stocks with the positive covariance, they are moving to the same way, same direction. Suppose in the economic crisis would happen or whatever, certain sudden things. So then X stock return is decreasing, Y stock return also decreasing because their covariance is positive. You know that risk and return theory. In the risk and return theory, when the return is increasing, now if you look at this period, return is increasing X for the stock X. For the Y also return is increasing. So this implies that when the return is increasing, how about the risk? Risk also increasing because risk and return going with the tender. There is a positive relationship in the theory. So when the return is increasing, it implies risk also increasing. Risk also increasing. For both stock, risk is increasing. So there is no trade-off between this risk and return in these two stocks. If you construct a portfolio using these two stocks, X and Y, two stock X and Y, you cannot gain diversification advantage. Why? When the X is increasing, Y also increasing. When the X is increasing, its risk is increasing. So Y stock's risk also increasing. So there is they are moving to the same direction, no any trade-off. अभी तुमको इकोनॉमी के बैड सिचुएशन है क्या नहीं इधर देखिए वो रिटर्न्स बाहर है तो आपके पोर्टफोलियो के रिस्क रिटर्न का आडू है अभी उधर याना पड़ा रिस्क का वैल्यू है ना पोर्टफोलियो एक्सपेक्टेड रिटर्न का वैल्यू ना रिस्क का वैल्यू है इधर when the correlation is positive, if the correlation is positive, you can see they are moving to the same direction in a particular time in the economy. So not possible to get the diversification advantage. Right? So this is the positive covariance. Positive here, this is like when the X is increasing, say this is Y stock return, this is X stock return. So you can see in a particular time when the X is increasing, Y also increasing. They are positively related. So let's look at the other one. This one, negative relation. Suppose that two stocks returns are moving like this. Then this is time. This is return. Right? Say X is going like this. Y is going like this. It became it like this. Now, if you take the time period from here to here, maybe let take a this is increasing. This return, X stock return is increasing. Y is decreasing. Y is going down. If you take the period from here to here, this is say X, Y. This is increasing. Other stock is decreasing. They are negatively related. So when the return is increasing for the stock X, it implies its risk also increasing. X on the return like value na whatever, yaar ke risk ka kya मायने? लेकिन theory का higher the risk, higher the return, higher the risk. They are positively related, going with tender. So when the Y stock return is decreasing, its risk is decreasing. Right? Are you return a value or what risk? Return a what risk? If you construct the portfolio taking the stocks with the negative covariance, you will see trade-off between risk and return. In a crisis situation, when the X is or the Y is decreasing, the other stock is increasing. So risk also increasing, here risk is decreasing. So if you combine these two stocks, you will get a trade-off. With the combination, with the combining or with the constructing a portfolio with the negative covariance stocks, you will get a benefit that we call diversification advantage. So there is a trade-off impact. Risk return trade-off advantage, risk return trade-off impact you can get. That is we call advantage of the diversification. Right? In the portfolio discussion, in the covariance, you will calculate correlation coefficient. This you will better understand with the correlation coefficient. Right? So when the two stocks positively related, positive mean like this, right? Sorry, negative mean like this. This is the stock X return, this is the Y. So this is the when the X is decreasing, you can see Y is increasing. Negative relationship. Covariance can positive, negative, or it can be zero. it can be 0. The 0. 0 means there is no relationship between these two stocks written. Say X is going over the time like this, Y is going over the time like this. Y stock returns is moving over the time like this. So there is no relationship between these two stocks return. Covariance is 0. Covariance is 0. So you cannot predict anything using the covariance is 0 because their covariance is 0. There is no identifiable relationship between these two stocks returns. But anyway, there will be a chance to get the moderate level diversification advantage with the 0 covariance also. Right? It is the 0 situation. Covariance is 0. Right. With that, you should know correlation coefficient also. But anyway, with the next, when it comes to the portfolio, I will go to the correlation coefficient. Now you learn what is covariance. Covariance is the co-movement. It measures whether the two stocks returns are moving to the same direction or opposite direction in a particular time. Covariance can be positive, negative, or 0. Right? The problem with the covariance, by looking at the covariance, suppose that covariance here 30. Covariance is 30. Covariance between these two stocks, X and Y. Say covariance between X and Y is 30. It's a value. It's a value. 30. So what you can say about by taking this 30? Suppose for this X and Y stock, you have calculated covariance. Now we are going to calculate it. It is 30. What you can say? This two stocks returns is positive. For movement is positive. It means that when the X stock returns is increasing in a particular time period, Y stock returns also increasing. But you cannot say when the X is increasing by 1%, by how much Y is increasing. You cannot tell that one. Size of the movement you cannot tell. By looking at the covariance, you can tell only the direction of the movement. Only the direction, whether they are moving to the positive or negative direction, or there is no any sort of relationship. But anyway, when this number is very large, suppose that covariance is 212, positive 212. When the covariance, that value, when it is large, it means that it implies that this covariance, this positive relationship is very strong. Positive relationship is very strong. Make a look positive number value size apply කරනවා මේ දෙන්න අතර තියෙන ධන සම්බන්ධතාවය very strong. මේක වැඩි වෙන correlation coefficient එක එකට ලං වෙනවා. අපේ next discussion එකේ අපි correlation coefficient එක කතා කරනවා. මේක අඩු වෙනකොට අපිට imply that positive relationship එක is very weak. ලොකු relationship එකක් නෙමෙයි. කොහොම ටිකක් තියනවා නෑ වගේ පොඩි යන්නේ වගේ අදහසක් එනවා. But anyway, you cannot tell exactly when X is increasing by say 1%, by how much Y will be. To identify that, in the next step we are calculating correlation coefficient number. Right. So let's calculate. I couldn't hear. Yes. Yes. Covariance always with the two stocks. Portfolio means not the two stocks portfolio. To be a well diversified portfolio, at least you have to invest more than 40. Your portfolio, at least you would have more than 40 stocks. But in this course, we discuss only the two stocks portfolio. So then you have to look at their covariance, correlation, coincidence structure. If the portfolio is slightly, you can realize that point to a certain level. Yes, you have to invest in the board. They came over to you. You will learn that one later. Let me discuss the portfolio. Right. So now calculate covariance for this X and Y. Calculate the covariance. So our example is this one. Right. This is the example. Right. So this is our example. Now you have already calculated expected return, standard deviation. Now calculate the covariance between these two stocks return, X and Y. Covariance between two stocks, X and Y. Our expected return for the X, expected return for the two stocks, X was 4.68, 4.68 and 3.42. So now we are going to calculate covariance between these two stock figures, X and Y. Covariance X and Y is equal. I think you can look at the formula if you need. Covariance is equal forecasted returns of X under the state of economy 1 minus 8.5. Its deviation from its expected return 4.68 into forecasted returns of Y under the same state of economy 8.5. Its deviation from the expected return of it 3.42 into the probability of happening in the first state of economy is 0.1 plus. So next, under the state of economy 2, forecasted returns of X 7.2, deviation from the expected into forecasted returns of Y under the same state of economy 0.54, deviation from the expected 3.42 into probability 0.2 plus. Likewise, in the third state of economy, forecasted 6.5, deviation from the expected forecasted stock Y on 3.42, probability 0.5 plus. The last forecasted 4.2, deviation from the expected of y 7.5 multiplied 7.5. Probability is 0.2. So get the total. That is the covariance. How much the covariance? Is it minus 10.73? Covariance is minus. So negative is two stock status in a particular type of economy in opposite direction. So 10.73. So it means that normally the order is x and y. So when the x is increasing, y stock return is decreasing. But you cannot tell the size of the movement. Simply you can tell they are moving to the opposite direction. Because negative covariance minus 10.73. So this is small number. So you can see negative correlation also not much strong, minus 10. So that's not much strong negative relationship, but anyway they are moving to the opposite direction. Right. So we need to identify one more things related to this standard deviation and the things. I will explain this for you understand it actually. So we discuss now expected return, average return, standard deviation, coefficient of variation, covariance. Normally, when it comes to the stock returns, it's a continuous variable. Stock returns is a statistically qualified as a type of variable that is continuous variable. So, the stock returns also you can explain by using properties of the normal distribution. Right? This is for your understanding, right? Because I am not going to check this one in the exam, but anyway, you will understand this one. How we use this risk and return to forecast. Suppose that you have calculated expected return and standard deviation. So you know the deviation or the dispersion of this expected return. So if you want to identify the probability of happening your return less than 0, greater than 0, less than 20. So likewise, by using these two statistic properties, you can do that. When you are taking a decision based on this expected return standard deviation, you can apply this statistic, and then I think you might have learned this thing in the statistics also. So we can forecast this expected return and its deviation by using a normal probability distribution properties. You know that in a normal distribution, in a variable, the normal distribution, so these are the expected return and the expected deviation. So normally it goes to the 100. So you can see in a normal distribution, you can tell from using 99.7.4 confidence that the value you are taken within the 3 standard deviation. In a normal distribution, if the stock returns are normally distributed, so then you can predict, you can interpret like this. You have a confidence 99.74 that expected value within 3 standard deviation. And also you have 95.46 confidence level. Your expected value, or if you take the, if you expected some value, it will be within 2 standard deviation. Here, 2 standard deviation. And also you have 68.26 confidence, or the probability sometimes 68.26 confidence, your expected value within 1 standard deviation. I'm not going to explain the statistics in more details, but anyway, you can interpret standard deviation and expected returns using these attributes. Now, in our example, let's look at this one, average return. These are for past 6 years average return. In our previous example, average was 3.17, standard deviation 11.16. Right? Average 3.17, standard deviation you calculate 11.16. So then, by looking at this and the standard deviation, what you can say? What you can say? You can say that you have 99% confidence that your expected value, your forecasted things based on this average within 3 standard deviation. We are using that normal curve properties. Now, this is the distribution of this one. Now, this is our normal curve. So here, mean is 3.17 in our calculation, right? But anyway, when you forecast using the normal distribution, you have to convert this 3.17 into 100 distribution. Normal distribution is 100 dollar. The maybe you have a 3.17 and 11.16. The maximum here make a 11.16 to make a 100 less than 100. But when you are using these normal distribution properties to explain this risk and return behavior, you have to convert these numbers. These are our numbers we got from the distribution real value. So this you have to convert using there is a formula. To the normal distribution, you have to fit this thing to the normal distribution. But anyway, here simply you can tell we have 95.46 confidence that our value, estimate return from the historical data using the past data sample, you can tell that with the 95.46 confidence, it will be within this range. If it is 95.46 confidence level, your value within 2 standard deviation. Within 2 standard deviation. 2 standard deviation means this is the standard deviation 11.16. 2 means this into 2. 11.16 into 2 means 22.32. Standard deviation දෙකක් අතර අපේ value එක TAV කියලා අපි focus කරනවා with the normal probability distribution එකේ properties එක 95.46 confidence level එකකින් ඔයා කියනවා ඔයාගේ expected value එක ඔයා expect කරන estimate කරන value එක using this sample will be within this range. deviation minus 19.15 to 25.49 අතර තියෙන්න පුළුවන්. That is the risk. That is the risk. According to this mean and this standard deviation, your distribution in between 3.17 plus 11.16 means this is 14 point. Here one standard deviation. You take the one standard deviation, so this is plus 3.17. This is 14 something. 14.16. If you consider the one standard deviation, so then here 11.16 minus 3.17. Here we get the 9.7. Again, to not give one. Maybe after here cut away to plus deviation negative after here 11.16 minus 3.17, 9.01. Around this is 9.01. 11.16 minus 3.17 or 3.17 plus 11.16. With the you can tell within 68.26% confidence. The confidence probability is confidence එක අඩුයි. මෙච්චර ලඟ වෙයි කියලා කියන්න බෑ. ඒකට මේක ලඟ වෙන risk එක අඩුයි. So then it is close to the average. මේක තමයි අපේ average එක. value එක අපි expect කරන්නේ මේක. But anyway the deviation of this average in between this and this range. So that is you can tell within using 68 point confidence level. With the 95.46 confidence level, if you forecast, your range will be within 2 standard deviations. Okay? So using this property, suppose that as an investor, you want to see the probability that actual future return less than 0. Okay. Using past 6 years average return of a company, you have calculated mean and standard deviation. Right? දැන් අපි analysis එකක් කරනකොට company එකේ පහුගිය annual returns අරගෙන අවුරුදු 5ක you have calculated average and standard deviation. ඉතින් දැන් මේකෙන් අපි මොකක්ද කරන්නේ? So likewise for the analysis you can take our average is 3.17. Standard deviation is 11.16. There are roughly idea එකක් තියෙනවා මේ company එකේ expected value එක මෙන්න මේ සීමාවෙ තියෙන්නේ. This is the average. If you consider the one standard deviation 3.17 plus 11.16 වැඩි වෙනවා නම් ඒ range එකට යනවා අඩු වෙනවා නම් 3.17 minus 11.16. Right? Suppose that using this average return and the standard deviation, you want to see the probability of happening your actual return less than 0. බිඳුවට වඩා අඩු වෙන්න තියෙන සම්භාවිතාවය කීයද if you invested of this company. This is less than 0. If you want to see the probability of happening this return less than 20, less than, now this is average 3.17. You want to see whether it is going to 0. What is the probability of that? Then you have to calculate this Z value. Right? This is statistics actually. So you have to apply this formula. By applying this formula, you have to calculate Z value. Here R is our expected or our interest rate range or our limit. That is 0. अब मेरा बाला 0 वाला टाटू में probability. So R is the return range limit to interest. So that is our expected number. Minus R bar is our average divided by standard deviation. So then you will get Z value minus 0.28. So it says that how many standard deviation is 0% away from the average. 0% is our expected number. 0 වලට අඩු වෙන්න තියෙන සම්භාවිතාවය තමයි හොයන්නේ. එතකොට this minus 0.28 tell you how many standard deviation this 0% is away from the 3.17. So then if you go to this one, so this is our average, say 3.17. So minus 0.228. So that is the 0 තියෙන තැන 0 එකට අදාළ value එක තමයි මේ හොයාගන්නේ. එතකොට මෙන්න මෙච්චරක් standard deviations වලින් එහාට ගිහිල්ලා තමයි මේ number එක තියෙන්නේ. So then this is the probability of happening your return less than 0. බිඳුවට අඩු වෙන negative පැත්තට යන සම්භාවිතාවය is standard table. So then this probability you can identify by looking at this Z table. In the statistics you have learned the Z table. So then you go to the Z table, look at this is the Z value. So approximately our number is there minus 0.28. So approximately probabilities you can take 38 probabilities is there. I think it is 38. Yes. The shaded area is located 0.28 standard deviation left to the mean. Right? 0.28 standard deviation in a pattern left. So then it indicates approximately there is a 38% probability. There is a 38% of the distribution. So there is a 38% probability your return going to be less than 0. So likewise, you can use this standard deviation, expected return, and average return to analyze the investment issue. This is some advanced things I explained, but don't worry on this time. Because for the exam, you should know what is standard deviation, how to calculate it, at least how to interpret that. Higher the standard deviation, higher the risk. So using standard deviation, you can tell that this expected number can increase by this much and decrease by this much. So this is the range. But anyway, if you are going to do the further analysis using these statistical things, so this our distribution, you have to convert it into the normal distribution. So then using the normal distribution properties, you can interpret your expected number, the probability of happening your return less than 20, greater than 20, less than 0. So likewise, you can identify the chance, probability of getting this return if you invested of this particular company. So likewise, you can do the analysis further. Am I confusing? So because I told you this one because otherwise no end. Then one standard deviation calculator, average calculator. So what? මොකක්ද ඉතින් යහගන්නේ? ඒතකොට මේ වගේ you can analyze it. Statistics ඕනයි. ඒක statistics තමයි මෙතන අපි apply කරන්නේ. Z value එක අරගෙන ඒක අපි normal distribution එකකට convert කරලා so you can analyze. I'm not going to tell more than that. Right. So now the next one is portfolio. So far we discussed how to determine average return standard deviation for individual stocks, expected return and risk for the individual stocks. Then we go to the portfolio of stocks. How to determine expected return and risk for the portfolio of stocks. So that is the important thing because as an investor, you are investing in a portfolio rather than investing in one single asset, your total wealth. So then you should know how to calculate expected return for the portfolio. Expected return, risk of the expected return of a portfolio. That is the most important thing in this lesson. Shall I continue like this? You need a break? What are the break? This one I think now you can manage yourself. Okay, so you are given return. You continue. So you are given return because I started with the late also. If you need, I will give you that. Now what is the time? What time? Alright, you want to go to at least. But anyway, now it is 10:30. You may come around 10:30. So you may come around 10:30. Within 10 minutes. So then we can start. I'm not going to explain this one, right? So you have to manage this one yourself. Just look at this one. See whether you have a confidence to manage this. But make karana pula nahi. What karana pula? Now you are given two stocks, X and Y. Probabilities are given separately for the X and Y, not same. So what is asking you? Calculate the expected return, calculate the variance, standard deviation, and also calculate coefficient of variation. It's not given here, but anyway, calculate the coefficient of variation and justify what would you select. Now you can do. We did it. So you can calculate the expected return for the X, expected return for the Z. So calculate the variance, standard deviation, and coefficient of variation, and take the decision. Right. So come and quickly. Remind the discussion that the AD part. At least model papers देखा ना हमारे पाके तो क्या वाला ये वाली हमारे वाला एक बच्चे के दार Ayah, ayah dan ada ayah Right, we can start. So we are going to the portfolio discussion now. So when it comes to the portfolio, you know that portfolio is a combination of assets. So rather you investing in the one particular company or one particular investment, you can invest your wealth in different investments. So we call it a portfolio. You can have a equity market portfolio, or you can construct the portfolio by investing part of your wealth in, say, treasury bills, corporate debentures, real estate like gold, lands, it's like real estate vehicles, and also part of your wealth you can invest in the stock market. So likewise, you can construct a portfolio. So by constructing a portfolio, what you expect, you are trying to minimize risk and maximize return, or you are trying to make a maximum return at a minimum level of risk. Because you know that all eggs, if you put in a one basket, once this particular basket is fallen out, your total all eggs will be destroyed. So like if you invest all wealth to have in a one particular investment, like people at that time they invested in the subsidy. You remember that subsidy? So they people went there to with the expectation of high interest, rather investing in the formal banks, government banks. They went there to get the high return, high interest rate. But they didn't know that high interest rate, high return implies that high risk. When they perceive it, when they are trying to get high return, so that is implies it consists high risk. So when the things are going worse, they expose that. Right. So likewise, so we are not going to discuss portfolio with the 40 stocks, but anyway, we will discuss the concept using two stocks portfolio. To understand this diversification effect, why it is important. So this is fundamental level financial management day. So therefore, you will learn what is portfolio, why we construct portfolio, how to decide, how to determine whether you have gained some diversification advantage. Right. So before starting that, investors make investment to achieve two main objectives. So normally, as an investor, you are trying to make certain objectives by investing. There are, according to the theory, portfolio management theory, there are two objectives. One we call non-satiation, and the other one is risk aversion. Non-satiation and risk aversion. By investing in an investment, you expect to achieve this objective. Non-satiation. What is this? Non-satiation, we call maximizing return in the simple term. Risk aversion means trying to avoid the risk in simple terms. So what is this non-satiation? For a given set of investment with the identical risk characteristics, investors tend to select the one which will generate highest expected return. So that nature, that behavior in portfolio sales we call as a non-satiation. You are trying to maximize return. Suppose a scenario like this, you have given two stocks A and B. With the expected return, say A, expected return, and standard deviations are given. The expected return stock A, say 20%, stock B, 25%. Standard deviations also given, say 12%, A, B also 12%. In such a scenario, if I ask you what is you are going to invest, which stocks you are going to select, which you are going to invest on which A or B? Expected return A 20%, B 25%. Standard deviation or risk 12% more. Now just don't think too much, but simply looking at this format. If I ask you which one you will select, one with the highest expected return, because the risk level is both are same. But anyway, you will see that these expected returns are different now. So then you have to look at the coefficient of variation. That is correct. But anyway, just forget about this thing. But in such a scenario, if I ask, you will select which one. You may go with this one, because when identical risk levels, with the risk characteristics or the risk level is same, identical, so you may select the one which gives the highest expected return. As a logical, rational investor with the identical risk level, if you have different investments with the identical risk level, you may go with one with the highest possible expected return. So that behavior we call non-satiation. So one objective of investment is to maximize return, not satiation. The other one is risk aversion. What is the risk aversion? Suppose that you are given again the scenario like this, say A, B. Expected return and standard deviation. Say expected return 20%. Expected return 20%, standard deviation 12%, standard deviation 18%. So risk aversion. What is the risk aversion? With identical expected return levels, investors demonstrate a tendency to select the investment that is lowest or that with the risk level. So that behavior we call risk aversion. Now here identical expected return 20%. In such a situation with the identical expected returns, so you may go with one with the lowest risk. You may select A if you are a general, rational, logical investor. So that is the behavior we call risk aversion. By investments, you want another objective is risk aversion, avoiding risk. The two objectives of the investment, non-satiation and risk aversion. In simple format, non-satiation, you want to maximize return. In the risk aversion, you want to minimize risk. Okay? You want to maximize return, you want to minimize risk. These are the objectives of the investment. But the problem is, you know that when you are maximizing return, risk also going with the penalty. When you are minimizing risk, your return is going line with the risk. So there is a contradiction. The two objectives of the investors to gain higher expected return and minimize risk conflict in each other. Because this theory, risk and return, you know that higher the risk, higher the expected return, higher the expected return, higher the risk. They are going moving positively. So therefore, you can see these objectives are conflicting. So what is we do? Now these two objectives are conflicting. So to achieve these two objectives at a moderate level, to achieve the both objectives to a moderate level, you are constructing a portfolio. Right? You cannot maximize return without getting certain level of risk. You cannot minimize risk without sacrificing return. So therefore, these two objectives, if you consider independently, they are conflicting. So therefore, to achieve both to moderate level, you may construct a portfolio. Investors construct the portfolio to be achieved. To achieve the both, be able to expect reasonable return while reducing potential risk. To get the both to a moderate level, so you may construct the portfolio. So what is the aim? What is the objective of constructing portfolio? Getting maximum return at a minimum level of risk. So you want return at a minimum level of risk. For that, we construct the portfolio. So this is some concepts or the theory behind the portfolio management. So I explained very simple way. So we construct the portfolio to get the reasonable level of return at a minimum level of risk. Right. So I think you have an idea about what is portfolio, why we construct the portfolio. So then as an investor, you should know how to determine portfolio expected return and the risk of the portfolio expected return. So that is you should know. You are going to invest in the portfolio rather than investing in one single particular security. You are going to construct the portfolio, how to calculate, how to determine portfolio expected return and portfolio risk. That is what we have to remains there to discuss. Portfolio expected return is easy, very easy. If you know the expected return for the individual stocks in the portfolio, and also if you know the weights or the size of this particular stocks investment in the portfolio, then you can calculate portfolio expected return. It is the weighted average of individual expected returns of the stocks in the portfolio. Weighted average expected return of the individual stocks in the portfolio. If you have 10 portfolios, if you have invested 1/10 each, so then your portfolio expected return stock 1 into its weight, expected return stock 2 into its weight. So likewise, you can get weighted average of individual stocks expected return. So that is the portfolio expected return. Weighted average. You can see the formula. Expected return stock I, its weight. Expected return stock X, its weight. Expected return stock Z, its weight. So get the total. That is the portfolio expected return. It is weighted average. It is weighted average of individual stocks expected return. This is easy. If you have 100 stocks in your portfolio, say weighted average. Portfolio के थोड़ा विस्तार किया ना वो invest करने बारी तैयार किया ना वाके वेल्थ के कोच्चरा make. So you can identify that weightages. Then you can identify expected return. You know how to determine the expected return for the individual stocks. If you know these things, you can calculate portfolio expected. Yeah, continue with the same example. I think you can remember this one. X and Y. So we are going to construct the portfolio using X and Y also. So you have calculated the expected return for the X and Y. 4.68, 3. Expected return X 4.68, 4.68, 3.47. Suppose you are going to construct the portfolio equally weighted with the X and Y. Equally weighted portfolio. What is the equally weighted portfolio? You invest 50% of your wealth on stock X, 50% of your wealth stock Y. Equally weighted. It can be equally weighted 60-40, 10-90, 80-20, so whatever weights. But suppose here you are going to construct a portfolio equally weighted with the stock X and Y. How much your portfolio expected return? What is your portfolio expected return? This is the stock X, its forecasted return, expected return, its distribution, all are there. This is the stock Y, expected return. So by combining these two, going to construct the portfolio equally weighted. Then portfolio expected return is how much? Expected return portfolio P, expected return P, expected return portfolio is equal expected return stock X 4.68 into its weight 50. So its weight is 50.5 plus expected return stock Y 3.42 into its weight 0.5. So get the total here, that is the portfolio expected return. Portfolio expected return. If you have 3 stocks, similarly, if you have 10 stocks in the portfolio, here weighted average expected returns of the individual stocks. Portfolio expected return. Expected return portfolio 4.05 is 4.0. This is your portfolio expected return. So you know average return.
Mass will be again.
Exactly, I can't say it now because feel like I'm not planning paper. Can you repeat calculation? I will consider it.
People like we can do
Theory question. I will consider. Don't consider. Don't consider. You prefer to do the calculation. Okay. So the answer is portfolio expected return is 4.05. Right. Now, what is the deviation? What is the dispersion? What is the risk of this expected return? So I am expecting 4.05 portfolio expected return if you construct this book. So what is the risk of that? What is the dispersion, deviation of this expected return? Again, we calculate standard deviation based on this portfolio expected return. So you have discussed the standard deviations and things. So you can see the formula. Even for the portfolio standard deviation, portfolio variance, this is portfolio variance, portfolio expected return variance. This is standard deviation, same. Square root of the variance, standard deviation. But remember, now if you look at this formula, just look at this. This is for the portfolio. This is for the portfolio. So here, portfolio forecasted return. This is portfolio. This is forecasted return of the portfolio. RPX, portfolio forecasted return under the state of economy 1. Its deviation from the portfolio expected return, of the deviation multiplied by the probability of happening in the state of economy 1. Then portfolio forecasted return under the state of economy 2, its deviation from the portfolio expected return, the probability of happening in the second state of economy. Portfolio forecasted return under the state of economy 2, its deviation from the portfolio expected return, probability of happening in third economic condition. So likewise, you can take the all and get the total, that is the variance. Square root of the variance is the standard deviation. So this is the statistical method. This is the statistical method to calculate the portfolio risk or the portfolio standard deviation. But the problem with this formula, if your portfolio, if it is consists with only the two stocks, this formula is not much complicated. You can manage. But when you know the portfolio is not always with the two stocks portfolio. Really, to be a well diversified portfolio, at least it should have more than 20, 30 stocks in the portfolio. So when there is a more or the large number of stocks in the portfolio, applying this formula possible but very difficult. It is very difficult. With the two stocks, you can do this one. Right? For the previous example, portfolio forecasted return you can calculate forecasted return X තියෙනවා, forecasted return Y තියෙනවා. ඒතර portfolio forecasted return කියලා කියන්නේ X වලින් 150යි, Y වලින් 150යි. So that is the portfolio forecasted return. ඒක expected portfolio return එකෙන් deviate වෙච්ච ප්‍රමාණය. So you can manage that. But with two stocks, but when 4 stocks, 6 stocks, so 10 likewise, when the portfolio stocks is increasing, applying this one is difficult. So therefore, in financial management, we are not applying statistical method to calculate the portfolio risk. But I can show you the answer by applying this one, but anyway, no need. Right? So we are not applying this statistical method, but remember, using the statistical method also, portfolio standard deviation you can calculate. But really difficult. We apply here to calculate the portfolio risk, we apply this double summation approach. This double summation formula. In financial management, we calculate the portfolio variance, portfolio standard deviation, not the statistical method, previous formula, but we apply this double summation formula or the double summation approach. What is it? This is for the two stocks. So if your portfolio consists only two stocks, this is the matrix. Column row matrix or the X and Y column and so this is we call 2 by 2 with matrix. We consider only the two stocks portfolio. So therefore you are now worry about the more than that. But if you have two stocks, this is the combination. So this is the relevant matrix. So based on that, this double summation approach has theorem. Now if you look at this double summation formula, this is weight stock X, it's stock X, weight above P into variance stock X plus weight stock Y above P, variance stock Y plus twice weight X, weight Y, covariance between two stocks X and Y. Now, if you look at this this formula, this matrix, from this matrix, this double summation formula is developed. Now, here you can see this is column 2 because we have only two stocks. There are 2 by 2 column and row, like a 2 by 2 matrix. All the stocks තියෙන දෙකයි. හතරක් තියෙනවා 4 by 2. 10ක් තියෙනවා 10 by 2. මෙතන තියෙන්නේ දෙකයි. ඒක දෙක තමයි කොලම් matrix එක හැදෙන්නේ. එතකොට here 2 by 2. So you can see this one, weight 1, weight 1. This is standard deviation stock 1. This is weight 2, standard deviation stock 2. Here you can see weight stock 2, weight stock 1. Here covariance between 2 and 1. Stocks දෙක අතර තියෙන variance. Here weight 1, weight 2, covariance between 1 and 2 or 2 and 1. Both are same. Now, if you apply this matrix to here, weight 1 1. Weight taker, stock 1 weight taker into stock 1 weight. The weight 1 square. It's a weight 1 take up 0. So then weight stock 1 or the x is square. Into this is variance. 1 1 covariance when this is variance stock 1. The way plus this one. Weight stock 2 is square. This is 2 to standard deviation 2 to this is variance between stock 2. So the variance stock 2 or the 1. It was made twice. Now method twice weight 1 weight 2 weight 1 weight 2. So then twice weight x weight y. Here covariance between 1 and 2. Here variance with covariance between 2 and 1. Covariance between stocks 2 x and y. Then we matrix again make n. Stocks. If you have 4 stocks, this is the matrix. So here you can see 16 elements. 16 elements. So then represent the 4 weighted variance. 1, 2, 3, 4 weighted variance. And 6 weighted variance counted twice. And with weighted variance, weighted variance so you can see the weighted covariance counted twice. This is covariance between 1 and 3. The covariance between 1 and 3 is this is covariance between 1 and 2, covariance between 1 and 2. So that is twice. Just look at the double summation formula if you apply this one, 16 elements. 16 elements. You can see there is a weighted covariance 4 elements. Make it here method the method terms it was a covariance method 6 1 2 3 4 5 6 twice 6 higher so double summation formula expand just imagine. So this is it. Your portfolio consists with the 4 stocks. Stocks are full of portfolio. If your portfolio consists with the say 30 securities, portfolio is really with the 20, 30, 40 stocks. If your portfolio with the 30 securities, you can see you have 30 weighted variance term, 30 weighted variance, and 870 weighted covariance. 870 combination. So manually you cannot do that. There is a software packages are there. So then you can calculate the risk. Risk depends on covariance. We are not going to consider at least 4 1, but anyway we consider only these two portfolio, 2 stocks portfolio. If it is a 2 stocks portfolio, this is the combination weight stock 1 extra and make a double denominator weight 1 weight 2 and the variance stock 1 plus weight 2 extra variance stock 2 and twice weight 1 weight 2 covariance between the x and y 1 and 2. So this is we call double summation approach. You can extend this formula to whatever the number of stocks in the portfolio. Covariance, variance combination you can expand this formula, not like the statistical method. Like previous statistical method very difficult to apply when the number of stocks are including more than 2. There are combinations calculate that is very difficult. But here you can extend this formula when the number of stocks are increasing in the portfolio. So that is for your understanding. So don't worry about because we discuss only the 2 asset portfolio. So this is the double summation formula applicable for you. So then accordingly you can calculate variance and standard deviation. So now you can calculate the variance because all the numbers we have calculated for example. Same example. So if you apply the double summation, this formula, what is the variance? Variance of the portfolio equals standard deviation calculate. Tell me the value. Standard deviation x and y dv. Variance 20 variance of x 20.0 variance x 20.34 standard deviation x 4.69 65 4.51 standard deviation. But the variance of x, the variance of y here are 21.85. Standard deviation y 4.67. अभी तक मैं आपको कैलकुलेट करना दिए थे. Apply the formula. Variance of the portfolio is equal weight of x square of that. The weight here 50%. Weight here 50%. So therefore 0.5. Of this variance of x, variance we calculated 20.34 plus weight of y 50% again. How of it? Variance stock y. Variance stock y 21.85. 21.85 plus twice standard deviation, sorry, twice weight x, weight y, 50.5, 50%, 5.5. Covariance between two stocks return. Covariance was minus 10.73, minus 10.73. So this will give you the variance of the portfolio. This is the variance. So take the square root of that. take the standard deviation. Variance එකේ වර්ගමූලය තමයි සම්මත අපගමනය. This is variance. So then you will get variance is how much? Variance is how much? 5.19. It is variance, right? 5.19 is the variance. 18. 18 is the variance. So once you get the square root of that, you will get standard deviation is it 2.28? Yes, 2.28. So when you apply this is the variance of the portfolio. Once you get the square root of that, you can see it is 2.28%. 2.28%. Right. Okay. Any questions on this? Calculation of the standard deviation using covariance. Right. So now, right. So now, here we calculate the risk of the portfolio using covariance. This one is the covariance. So we calculate the portfolio risk using covariance. I explained you what is the covariance. Covariance measure the co-movements of or the direction of the two stocks return. But I told you that the problem with the covariance, it doesn't give you the size of the movement. Simply minus 10.07 just say that these two stocks are moving to the opposite direction. But it doesn't say anything the size of the movement. So therefore, covariance, now in our formula, in the double summation formula, we apply the covariance. This one. If you go to the formula, here we apply the covariance. Right? Covariance between the two stocks return. This covariance, you can rewrite like this. Covariance between two stocks return, covariance between two stocks return, say x and y, is equal standard deviation x, standard deviation y, correlation coefficient between the two stocks return. Correlation coefficient, we call it the raw value, or you can say CORR, correlation coefficient. Correlation coefficient between two stocks return, say x and y. Covariance is equal, covariance between the two stocks return is equal standard deviation stock x, standard deviation stock y, correlation coefficient. Correlation coefficient between the two stocks return x and y. Correlation coefficient. Right? So you should know the importance of the correlation coefficient, because by looking at this correlation coefficient, you can identify whether this two, by combining these two stocks in the portfolio, whether you can get a diversification effect or not. Let's see what is the correlation coefficient. You should know that. We discussed covariance, you learned it. So now let's see what is the correlation coefficient. Correlation coefficient you can calculate like this. Again, this correlation coefficient we are using to measure the co-movements of the two stocks return. Right? Covariance is equal standard deviation stock x, standard deviation y, correlation coefficient. සහ සම්බන්ධතා සම්පූර්ණකේ. සහ විචලතාවය තමයි ඉස්සෙල්ලා අපි ගහුවේ මේ සහ සම්බන්ධතා සම්පූර්ණකේ correlation coefficient. So correlation coefficient is equal to this. So then you can rearrange this formula for correlation coefficient. It is equal covariance divided by standard deviation stock x, standard deviation stock y. You know the covariance, standard deviations, then you can calculate correlation coefficient. So in our example, you know what is the standard deviation stock x, standard deviation stock y, and also we did the covariance minus 10 for example. So then you can calculate correlation coefficient. Before interpretation that you can take the value. Right. Let's take it later. But you should know what is correlation coefficient. Normally correlation coefficient like it goes between -1 to 0 to 1. It goes in this range. -1 to 0 to +1. The correlation coefficient එක 1.5 වෙන්න පුළුවන්ද? Less than 1. මේ range එකේ තමයි correlation coefficient එක තියෙන්නේ. -1 to 0 to +1. If correlation coefficient is -1, we call it perfectly negative correlation. Perfectly negative. Right? Perfectly negative. So how to interpret that? If correlation coefficient is -1, that is perfectly negative situation. So it means that when the x stock return is increasing by 1%, y stock return is decreasing by same amount. Because they are perfectly negative. perfectly negative. සම්පූර්ණයෙන්ම ඍණ සම්බන්ධතාවයක් තියෙන. දැන් අපි covariance එකෙන් අපි දැක්ක අපේ stock X and Y අතර තියෙන covariance එක negative. ඍණ 10යි නේ. ඒතර ඍණ 10න් අපි කිව්වා දෙන්නගේ stocks වල behavior එක ඍණ. ඒ කියන්නේ එක්කෙනෙක් වැඩි වෙනකොට අනිත් එක්කෙනා අඩු වෙනවා. behavior එක ඍණ. හැබැයි අපිට කියන්න බෑ x මෙච්චරක් උඩ යනකොට y කොච්චරක් පල්ලෙහාට යනවා කියලා. හැබැයි correlation coefficient එක calculate කරපුවාම ඔයාලට කියන්න පුළුවන් x එකකින් උඩ යනකොට 100ට y කොච්චරකින් අඩු වෙනවද. Then if the correlation coefficient is negative one, it can perfectly negative, it means that when the x is increasing by 10%, y is decreasing by 10%. Same amount. Right. If correlation coefficient is 0, these are the extreme value. -1, 0, +1 are the extreme. Commonly, practically in the stock market, rare to identify these extreme numbers. Okay, ඔය අතර තමයි තියෙන්නේ correlation coefficient. ඍණ එකක් කියන එක ටිකක් අමාරුයි. Rarely you will identify. 0, +1, same. If correlation coefficient is 0, බිඳුවයි. No relationship between these two stocks returns. Okay? You cannot tell anything about when the correlation coefficient is 0. X that you know y කොච්චරකින් අඩුවෙනවද කියලා කියන්න බෑ. Because correlation coefficient is 0. Relationship is none. If correlation coefficient is +1, perfectly positive relationship. So you can interpret when the x is increasing by 1% in their return, y increasing or decreasing? Increasing by same amount. If correlation coefficient is say -0.58, correlation coefficient is -0.58. How to interpret that? Theory ප්‍රශ්න ගණන් දෙකේ අපි අහමු අපේ යාළුවා. If correlation coefficient is -0.58, how to interpret that? What? ඔයාලා කිතුලටදී මොකක්ද මේ කිතුලටදී කවුද? How to interpret that? How to interpret? -0.58. Correlation coefficient is 0.58 minus. How to interpret? X and Y related to the X and Y stocks. Increasing. What is the size? Direction is negative. So what is the size of the change? When X is increasing by 1%, Y is increasing by less than 1. Perfectly negative there. Perfectly less than 1. What is the amount? By 0.58. So ඒක 100 උනත් කියන්න පුළුවන්. 10 උනත් කියන්න පුළුවන්. 10 කියනකොට අරක 5.8 අඩු වෙනවා. 100 උනත් කියන්න පුළුවන්. So that is the interpretation. If it is positive 0.58, when the x is increasing by 1%, y is increasing by 0.58. So likewise, now you can see that covariance gives you the directions only. Covariance again with the correlation coefficient, you can tell what is the size of the movement. Right. Now calculate the in our example correlation coefficient for the our example x and y correlation coefficient. Covariance was -10 point. So you can calculate correlation coefficient for our example is minus 0.51. Next, you can check it. Correlation was minus 10.73. Standard deviation is 4.51. Standard deviation y 4.67. So then correlation coefficient is minus 0.51. Negative. So you can interpret when the x in a particular time of the economy, stock returns of the x increased by 1%, y return is decreasing by 0.51 because they are negatively related. It will get the same answer. In the formula, instead of the covariance, if you apply this, covariance is equal standard deviation x, standard deviation y, correlation coefficient x and y. If you apply this thing, you will get the same answer. You can extend the double summation formula using the correlation coefficient also. Right. So now we have calculated portfolio risk, portfolio expected return. So now you have to determine, but rather than invest in X and Y separately, right? Rather than invest in X and Y separately or the independently, if you construct the portfolio using X and Y, you have a diversification advantage. That is the ending of our story. The important thing. Rather invest in X and Y separately. When X and Y will invest for us, you know what is the expected return, what is the risk. If you construct the portfolio using X and Y, equally weighted portfolio expected return was 4 point something. This is the portfolio risk, 2.28. So now I am asking question, by constructing the portfolio, do you have any risk diversification? Is there any possibility to minimize the risk, to maximize the return, so that you should be able to determine? Right. So now looking at this, if you read this one, the risk of a portfolio return depends on correlation, covariance structure of the stock in the portfolio. Recall the double summation approach. Portfolio standard deviation depends on covariance and correlation. Like portfolio expected return is a weighted average. It is simply weighted average. But risk of the portfolio or the variance or the standard deviation of the portfolio impacted or the affected with these numbers. Covariance, correlation structure. Metrics එක මතක් කරගන්න. හතරක් වුණ covariance structures 16ක් ආවා. Stocks 30ක් තිබුණොත් covariance structures 876ක්. ඒතර ඒකේ rate එක මත තමයි portfolio එකේ risk එක depend වෙන්නේ. ඒතර portfolio risk is depends on correlations or the covariance structure of the return of the stocks in the portfolio. When the correlation of two stocks is equal to 1, correlation coefficient of the two stocks return is equal to 1, perfectly positive. Equal to 1 කියලා කියන්නේ perfectly positive. Perfectly positive. The standard deviation of the portfolio is the weighted average standard deviation of the stock. If you read this, if correlation coefficient of the two stocks in the portfolio, it is 1, perfectly positive now. Standard deviation of the portfolio. Again, portfolio ke risk hai. Standard deviation of the portfolio is equal to weighted average standard deviation of the stock. Now go to the example. Now here, suppose here instead of this minus 0.51, say correlation coefficient is equal to 1, positive 1, right? Positive 1. We calculate this number. මොකද කරන්න ඕන මෙතන -0.51 වෙනකොට එකක් දාන්න. Correlation coefficient, just suppose that it is 1. So you see what is the portfolio risk. We calculate changing this number. So here, what is the answer? If you change here 1, positive 1, you will get then take the here in the portfolio risk taken. 2 point. What is the correlation coefficient is P, or the correlation coefficient between X and Y. If it is equal to 1, what is the portfolio risk? Variance එක අරගෙන standard deviation එක ගන්න ඕන. 4.5. 4.5. We get 4.5. Now calculate weighted average standard deviation value of the individual stocks. The method X standard deviation together. Stock X standard deviation is how much? Standard 4.68. 4.51. This is the standard deviation. Stock X 4.51. Standard deviation Y 4.67. 4.67. So calculate weighted average standard deviation here. Weighted average standard deviation how much? Weighted average standard deviation means 50, 4.51, 50, 4.67. Weighted average standard deviation. of the individual stocks. Here then, same day, 4.59. You will get the same answer, 4.59. So what is then point? Taking our example, the calculations are clear. You have to take the correct one, right? So if the correlation coefficient is perfectly positive one, portfolio risk is equal to weighted average standard deviation value. Now go to the explanation. If correlation is positive one, perfectly positive, standard deviation of the portfolio is equal to weighted average standard deviation value. Now you realize it. Formula value same answer. If correlation of two stocks is less than 1, if it is less than 1, standard deviation of the portfolio is less than the weighted average standard deviation value. In our example, our correlation coefficient is minus 0.51. It is also less than 1. Or if you take the 0.58 instead of, you will get the answer portfolio standard deviation less than the weighted average standard deviation value. Since the correlation of the two stocks in general less than 1, the standard deviation of the portfolio is less than the weighted average standard deviation of the stock. This effect we call diversification advantage. Right? So if correlation coefficient is perfectly positive, there is no diversification advantage. Why? Portfolio risk is equal to weighted average standard deviation value. There a diversification benefit if the correlation coefficient is perfectly positive, no diversification advantage. But in general, private okay. Correlation coefficient normally less than 1, so you will get diversification advantage. Diversification always reduces the risk provided the correlation coefficient is less than 1. You can highlight that. Diversification advantage you can get when the correlation coefficient is less than 1. So in our example, do you have a diversification advantage? Yes, because our correlation coefficient is negative. So there is a diversification advantage. Now if you go to the numbers, this is wrong. Huh? This is wrong. So here our correlation coefficient was minus 0.51. This is our answer. Now here, look at here. If you invested stock X only, this is your expected return. This is the risk, 4.67. If you invested Y only, this is the expected return. This is the risk return. Standard deviation. If you construct portfolio equally weighted by investing 50-50, your portfolio expected return was portfolio 4.05. Portfolio expected return was 4.05. Portfolio risk was 2.28. What you can say? If you invested both, they came investor or return the portfolio return is greater than 3.42, 4.6.8. In between these two stocks return, you can get the portfolio return. What happens to the risk level? Portfolio risk. It is less than these two numbers. So there is a diversification advantage. Rather than investing in the individual, independent X and Y, you might construct the portfolio. If you construct the portfolio, you can get this much return at the minimum level of risk. We construct portfolio for what? Get the maximum possible return at a minimum level of risk. So that's advantage. There is a risk diversification. Because how this risk diversification achieved? Because our covariance is negative, correlation coefficient is negative 0.51. It is less than 1, as well as it is negative. It is negative this diversification advantage. This is less than 1, negative. So therefore, you can reduce your risk of these individual stocks up to this by constructing the portfolio. X වල විතරක් ඉන්වෙස්ට් කරොත් 4.67ක් තිබිච්ච risk එක Y වල විතරක් ඉන්වෙස්ට් කරොත් 4.51ක් තිබිච්ච risk එක මේ දෙන්න එකතු කරලා portfolio එකක් හැදුවොත් මෙතන එනකම් අඩු කරගන්න පුළුවන්. Equally weighted මේ equally weighted දාලා ඔක 60 80 වෙනකොට වෙනස් වෙනවා 90 වෙනකොට වෙනස් වෙනවා අපිට structure එක වෙනස් කර හැකි weightages වෙනස් කර හැකි. එතකොට මේක තමයි එහෙම වෙනවා. There is a possibility to decrease that. Right? So, what is the conclusion? Diversification effect depends on covariance correlation structure. If the correlation coefficient is perfectly positive, no diversification advantage. සාසම්බන්ධ සාකුණකේ ධන එකයි නා perfectly positive නා diversification advantage එකක් නැහැ. But if correlation coefficient is less than 1, you will get the diversification advantage based on this strength or the level of this relationship. If it is less than 1, now the correlation coefficient is 0.95. Correlation coefficient is 0.95. You have a diversification advantage. Positive 0.95. Yes, you have a certain level, but it is very small. ඒ දෙන්නගේ relationship එක එකට ගොඩක් ළඟයි. Perfectly positive පැත්තට බරයි. අපි හිතමු correlation coefficient is -0.8. Yes, there is a diversification advantage. Advantage එක ගොඩක් වැඩි. මේක මේ risk එක ගොඩක් පල්ලෙහාට පස්ස ගන්න පුළුවන්. දැන් අර 0.95 වල තියෙනකොට මේ එච්චර අඩු වෙන්නේ නැහැ. අර individual stocks වල risk level එකට කොහොම සමීපව චුට්ටක් අඩු වෙනවා තියෙන්නේ. ඒක moderate level diversification advantage එකක් තියෙනවා. හැබැයි correlation coefficient එක -0.85 වුණොත් දින එකට ළඟයි. ධන එක නෙමෙයි ඍණ එක පැත්තට බලන්න. ඒතකොට you will get high diversification advantage. So therefore you must realize that diversification benefit depends on what? Correlation structure, covariance structure of the two stocks. Right. So this is the end of one thing. But anyway, you should know this one. Now look at this thing. Any question? Any clarification? Do you have any questions? Any clarification? How about others? Now look at this example. You can see a separate example. Stock MN. You are given expected return, standard deviation. Right? Expected return, standard deviation. Suppose that using Excel you can do that, right? Even with Excel you can do. Suppose you are going to construct different portfolio by changing the weights as well as by changing the correlation coefficient in between -1 to +1. මේ stocks දෙක අරගෙන අපි portfolios ගොඩාක් combinations හදන්න යනවා. එකක් correlation එක වෙනස් කරමින් අනිත් එක weights වෙනස් කරනවා. Right. So if you construct like this, you can see if you take correlation coefficient as -1. -1 means perfectly negative. So this is the behavior of portfolio expected return and risk for different combinations, different weights. Now this is if you invested, look at this point, the point about the stock M. If you invested stock M only, M වල විතරක් ආයෝජනය කරොත් මේ තමයි යාගේ risk level එක. This is standard deviation of the portfolio. මේ තියෙන්නේ යාගේ expected return. If you invested stock M only. If you invested stock N only. N වල විතරක් invest කරොත් මේ තියෙන්නේ යාගේ standard deviation එක risk level එක මේ තියෙන්නේ යාගේ expected return. Right? If you construct a portfolio combining N and M, and then if you construct a portfolio and assuming correlation coefficient is -1, perfectly negative. If you construct portfolio change in the weights, different weights, 60, 40, 10, 90, so likewise different weights, 50, 50, so different weights. So you can see the risk of the stock N, you can decrease like this. It's also decreasing like this. There is a possibility, there is a point where portfolio risk is going to zero. Portfolio risk is zero, portfolio expected return somewhere here. This is the path. මේ තමයි portfolio expected return එකයි risk එකයි ගමන් කරන path එක. දැන් මේ හරියදී මේක combination එකක් මේ තමයි risk එක මේ තමයි portfolio එකේ expected return. මේ හරියදී මේක risk එක මේ portfolio එකේ expected. So these are different combinations. The Excel you can draw this. With the 60-40 වාගේ there is a possibility when මේ point එක මේක Excel එකෙන් හදලා තියෙන්නේ මේක click කරලා තියෙනවා data වලට. In this point you can see risk of the portfolio zero. Expected return 22.5, 22.2 line. So there is a possibility to eliminate risk total. If you can identify stocks with a perfectly negative correlation, there is a chance, there is a possibility to eliminate risk to zero totally. There is a possibility. But anyway, in the practice in the market portfolio, it's extreme number. Correlation coefficient, this is extreme, -1, perfectly negative, very rare to find. Samadhe extreme values are due. Tina එක බිඳුව එක කියන values නෑ. ඔය අතර තමයි correlation coefficients තියෙන්නේ. But if you can identify -1 portfolio, can possible. Right. Now if you look at this one, if correlation coefficient if you take as the 0, correlation coefficient එක බිඳුව කියලා අරගෙන ආපහු අපි විවිධ combinations හදලා මේ diagram එක draw කරා. This is the path. This is the path of the portfolio expected return and portfolio risk. මේකේ මොකද වෙලා තියෙන්නේ? මේ තියෙන්නේ M වල විතරක් ඉන්වෙස්ට් කරොත් risk එක. මේ තියෙන්නේ M වල විතරක් ඉන්වෙස්ට් කරොත් මෙතන කැපිටල් කවුරුත් නැහැ. Is it target? You can understand single? You can single. Alright. So if you invested N only, this is the risk level. If you invested M only, this is the risk level. If you combine these two and if you construct portfolio, this is the path of expected return and the risk of the portfolio. If correlation coefficient is 0, even in the 0 case, but you can observe moderate level diversification is there. Means risk එක අඩු වෙනවා. Risk එක මෙහෙම අඩු වෙලා මෙතනට වෙනකන් you can reduce. But when the correlation coefficient is 0, this never approach to here. It can be a diagram or the behavior like this, but this point never approach to here. The correlation coefficient is 0. So what is the conclusion? When the correlation coefficient is 0, even moderate level diversification advantage is possible. So then this part, green part. If correlation coefficient is perfectly positive 1, what has happened? This is the path for the portfolio expected return and portfolio risk. Green line. Green line. This is the path. Now what you can see. Portfolio risk, portfolio expected return in between these two. This is if you invested stock M only, expected return and the risk. This is if you invested N only, risk and the expected return. So So you can see portfolio expected return and risk in between here. Make a straight line, make a never. So that is why I told you, when the correlation coefficient is perfectly positive, no diversification advantage. Portfolio risk, simply weighted average standard deviation. Straight line becomes, this is a straight line. So portfolio risk is weighted average standard deviation. So there is no diversification effect. There is no diversification effect. There is again you can see diversification advantage is there. This purple line up to 0 you can reduce the risk. If correlation coefficient is perfectly negative. So this is you can possible. With the correlation coefficient, you can identify stocks like this. Right. Before coming to this point, right now, you can remember this lecture I started with the formula. This calendar topic I started with the formula. You remember required rate of return is equal risk-free rate of return plus required rate of return is equal risk-free rate of return plus risk-free. Now in the previous discussion, you realize that if you can identify stocks with the perfectly negative correlation, there is a possibility to minimize risk up to 0. Totally elimination. Totally you can eliminate the risk. Okay? You saw it. If so, if by constructing a well diversified portfolio, if you can diversify risk totally, why risk premium here? If you are by constructing the portfolio, by constructing well diversified portfolio, there is a chance. This is a free lunch. Make a free lunch. Make a cost on that. This is purely coming with the correlation coefficient structure. 0 cost. If you can construct the well diversified portfolio, you have a possibility to minimize risk up to 0. Theoretically. If so, then if you can minimize risk up to 0, if you are a rational logical investor, why risk premium? No need to give the risk premium. By constructing a portfolio, you can reduce this risk up to 0. Here, the risk premium for bearing risk. Risk-free rate of for the time value of money. So, if there is no risk, if you can construct portfolio and if you can minimize it, if you can eliminate it, this risk premium is for what? For the investors. This is where the investment portfolio management is started. When it's come to the risk includes or it consists with the 2 types of risk. With the standard deviation, you calculated total risk. This is actually the story of the portfolio. From this point onwards, I go to the captive with the data. That's only. If it is now you are fully loaded, I can stop rather than discussing the detailed thing. But anyway, this point is important. When it's come to the risk, you can divide it into the systematic risk, unsystematic risk. Systematic means we call market risk, undiversifiable risk. Unsystematic risk means we call firm specific risk or diversifiable risk. By constructing a portfolio, you can diversify away only this unsystematic risk, or we call firm specific risk. What are the examples? Unsystematic risk, diversifiable risk, or firm specific risk can arise because of the firm related factors. Say components of specific to the particular company, the raw materials they are used in trade, union actions, employees, their production process can be diversified and reconstructed the portfolio without incurring the cost. This unsystematic risk arise because of the firm-specific factors. In a particular company, they are using very low quality raw materials in their production process. So it is a risk arise under this unsystematic part. So if you are a rational investor, you can diversify this part of risk by investing in another company, by investing in negatively related company of this particular company. A correlation, but you can identify stocks negatively related for this with this particular company. Then if your portfolio is consists with the say, you have a single input, kuda hadana companies ice cream hadana. Wahina kalaka kuda wala dennu badi na ice paayana kala ice cream ka. They are negatively correlated. Therefore, you will get a risk return trade-off and you will get the diversification and growth. So likewise, this unsystematic part of the risk, by constructing a well-diversified portfolio, you can totally diversify the risk. But the systematic risk, what we call market risk, what we call non-diversifiable risk, even though you construct well-diversified portfolio with the 100, 200, 500 stocks, still you are affected with this systematic risk. What are the systematic risk sources? These are the risks arise because of the macroeconomical factors, inflation, foreign exchange rates, tsunami, earthquake, like natural disasters. So these are, you cannot diversify them away. All the investors are equally affected. The component depends on the macroeconomic factors, GDP, political instability, terrorist attack. So these are coming from uncontrollable, unavoidable sources. It is unavoidable. It cannot be diversified by constructing the portfolio. So therefore, investors should have some risk premium for bearing this systematic risk. So risk premium is provided for what? Systematic risk. Because no need to give the premium for the unsystematic risk. If you are a rational investor, you should be able to diversify this one by constructing a portfolio. But this one, you cannot. So therefore, this risk premium for bearing systematic risk. From this point onwards, in our portfolio, in the capital, in beta calculation, whatever. So what is the relevant risk then? What is the relevant risk? Risk again, systematic risk. That is the relevant risk. So from this onwards, we discussed the things. Alright, now look at this diagram also. The same thing is implied. Now here, number of stocks in the portfolio. This is portfolio risk. You know what is portfolio risk? Standard deviation of the portfolio. The number of stocks in the portfolio is increasing like this. This is total risk. Total risk means unsystematic risk plus systematic risk. Total risk. Maybe a total risk. Right? From here to here, total risk, unsystematic risk plus systematic risk. When the number of assets are increasing in the portfolio, total risk is decreasing. It's coming up to this point. Even though you increase number of stocks to 1,000, it's never coming from this point, this level. Why? This is systematic risk, undiversifiable risk. Even though you construct a well-diversified portfolio, total risk is total risk is unsystematic risk diversified. But the systematic risk remains constant. It remains constant, so you should have some premium for bearing this systematic risk. Any question? I'm not going to discuss this point. I will like to discuss a tutorial question. Any question? Anything එහාට ටික capital B එකයි කරනවද නැද්ද? Is it very difficult to understand? Huh? Because දැන් මෙතන එහාට තව market portfolio එකයි capital එකයි B එකයි. ඒක ටික මේක syllabus එකේ තියෙනවා. Your syllabus is included. So I have put the capital B and the things. I can explain the story. I think you better to know it. For the exam, I will not ask the question, but anyway, the story is interesting. Because with the market portfolio, now in our Sri Lankan countries, what is our market portfolio? Colombo stock exchange. That is our market portfolio. That market portfolio consists of 298 stocks. We identify this market portfolio theoretically as the well-diversified portfolio. In the market portfolio, there is no unsystematic. So then, suppose that in the market portfolio, there is a Sampath-backed PSU. There is a market portfolio, one company is the Sampath-backed PSU. There is Sampath-backed PSU included in the market portfolio. So if you want to identify systematic risk of the Sampath-backed PSU, so you have to calculate contribution of the Sampath-backed PSU to the market risk. Make a like a story, right? It's about appeal Sampath-backed PSU systematic risk factor you need if you are going to invest in the Sampath-backed PSU to calculate your required rate of return. You should know what is the systematic risk premium. So then you have to calculate that related to the market risk. So we are using the factor beta. With the beta coefficient, you can identify systematic risk. If you go to the Colombo stock exchange, for the 298 companies, beta coefficients they are calculated. So based on this beta coefficient, you can identify your risk premium. Based on that, you can calculate your required rate of return. So these are the things I want to discuss under beyond this point. Related to the market portfolio, we are using an empirical model called capital asset pricing model. With this campaign, you can identify what is the risk premium. So that is the end of this, at least first stage of this problem. These are going to the portfolio management, but anyway, I think you better to know. Then today I'm not going to do that. In the next week, after you thoroughly study these things, I will take only the say maximum 45 minutes. I will explain the story, and I will go to the first one. So anyway, you may come up with a proper reading. You may look at this thing what we discussed so far, then you can understand that concept clearly. I have presentation also. Anyway, look at this tutorial. So now look at this tutorial. So you should know beta. In order to really to complete this discussion, you should know beta, and based on the beta, you should be able to calculate expected return. So based on that, you will identify whether the stocks are undervalued or overvalued for the investment. So that is actually you should know. We'll see in the next lecture. Now look at this equation. This is also you cannot do because here let's explain a bit about it. Let's look at this one. This one you can do. Forecasted return for the stock sun and moon under the possible future economic conditions given with the three economic conditions. If the investor wish to invest 60% of his wealth in sun and the rest in the moon, so calculate expected return sun and moon, standard deviation sun and moon, correlation coefficient between sun and moon, and expected return portfolio weighted standard deviation, and finally conclude whether by constructing this portfolio you are getting a diversification advantage or not. This is based on the discussion after this. Let me put your hands if you feel like you have confidence to do this kind of question. Just put your hands this data assessment. And may have take up Karagana feel when I just tell me. Nobody's there. Why? Huh? Really? Frankly, because I want to test whether you have done this. But it's not done. Let us study. So let's discuss this question. We have time. Right. Huh? Okay, start that. Adana. So you can have this one in your tutorial. Right. Anyway, calculate the expected return, standard deviation for the group and sum. So you know how to calculate expected return. Maybe space का करने को रहता है ना मैं कीबोर्ड देख लेगा बट मैं Right. So you can calculate expected return from X. So expected, sorry, not X, sum. Expected return sum is equal, you know, the formula. Forecast return under the recession into its probability plus forecasted return under the normal 6 into probability plus forecasted return under the moon 18% its probability. So this is the expected return sun. So same way you can calculate expected return for moon and sun. So what are the values expected return sun? What is the answer? 12.5. 12.3. So expected return moon here 13.7. Then you can calculate standard deviation for sun and moon. Standard deviation, before standard deviation you have to calculate variance. Sun is equal, you can remember the formula. Deviation of the forecasted return from the expected for 4 minus 12.3. Square of the deviation into relevant probability. Plus, in normal economy occurred, forecasted return is 6%. Its deviation from expected 12.3. Square of that probability 0.3 plus forecasted 18% minus expected power of the deviation probability 0.5. So this is the variance. Once you get the square root of that, is the standard deviation.